Imagine two people. Both are 28 years old, both earn $65,000 a year, and have saved $50,000. But they have completely different ideas about investing. Sumit believes real estate is the best way to build serious wealth. He likes owning something physical. A house feels real to him. Lucas thinks differently. He wants an investment that can grow without taking over his life. No tenants, no repairs, no phone calls at midnight. So he chooses the stock market. They both start with the same $50,000, and over the next 20 years, something interesting happens. Because the biggest difference isn't simply where they put their money, it's how their money works. Let's start with Sumit. Sumit buys a rental property. Sumit uses his $50,000 as a 20% down payment on a $250,000 rental property. He takes a 30-year mortgage at 7% with a monthly payment of roughly $1,330. A few weeks later, he finds a tenant paying $1,800 a month. At first glance, the deal looks amazing. Rent is $1,800, while the mortgage costs around $1,330, leaving roughly $470. But rent isn't profit. The property still has taxes, insurance, maintenance, vacancies, and repairs. Things break. Tenants move out. Appliances stop working. Roofs get old. Sumit manages everything himself, saving on property management costs. But now he's paying with something else: his time. Still, he doesn't regret the decision. The property is appreciating, the tenant is helping pay down the mortgage, and his ownership stake keeps growing. Lucas takes the boring route. Lucas puts his $50,000 into a broad stock market index fund. He doesn't borrow money or buy individual stocks. He simply owns a small piece of thousands of businesses through one investment. And then he does something extremely boring. He automates another $200 investment every month. That's it. No market timing. No trying to predict the next crash. No jumping into trending stocks. Most months, Lucas barely thinks about the investment. His money is working while he's working, sleeping, traveling, and living his life. The first 5 years. During the first few years, Sumit feels confident. The property value rises, rent comes in, and his mortgage balance slowly falls. But then expenses appear. Maintenance, insurance, taxes, vacancies, repairs, and management costs begin eating into the $470 monthly difference between rent and mortgage. This is one of the biggest mistakes new real estate investors make. They calculate rent minus mortgage equals profit. It doesn't. The real calculation includes mortgage, taxes, insurance, maintenance, vacancy, repairs, management, and other costs. Only then do you know what the property is actually producing. Lucas has a less dramatic experience. His portfolio moves up, then down, then up again. Some years are great, some are painful. But he keeps investing, and slowly, something begins to change. The power of compounding. At first, Lucas's $200 monthly contribution seems important. But eventually, the portfolio itself becomes more important. Imagine Lucas has built a portfolio worth $100,000. A 10% gain would be $10,000. That's equivalent to 50 months of his $200 contributions. This is where compounding starts becoming powerful. The investor isn't just adding money anymore. The money already invested is producing new money. And that new money can produce even more money. That's why long-term investing can feel disappointing in the beginning and surprisingly powerful later. But Sumit has another weapon Lucas doesn't have: leverage. The advantage of leverage. Sumit started with $50,000, but he controls a $250,000 property. If that property rises 20% in value, it gains $50,000. That's equal to Sumit's original down payment. That's the power of leverage. It can dramatically increase returns, and it can dramatically increase losses. You're controlling a large asset with a relatively small amount of your own capital. But leverage also creates obligations. The bank still wants its mortgage payment, even if the property is empty, the market falls, or the roof needs replacing. 10 years later, Sumit's property has appreciated significantly. His mortgage balance has fallen. His equity has grown. He also receives rental income. On paper, he has built substantial wealth. But he has also spent years dealing with taxes, insurance, maintenance, repairs, vacancies, and unexpected bills. Lucas has taken the opposite approach. His portfolio has continued growing. He has contributed consistently every month, without needing major decisions. His biggest responsibility has been staying invested when the market becomes uncomfortable. No tenant, no contractor, no mortgage, no leaking roof. The hidden cost of the stock market. Imagine waking up one morning and seeing your portfolio down 30%. Nothing about your life has changed. You still have the same job, house, and car. But your investment account suddenly looks much smaller. That's the psychological challenge of stock investing. The market can fall quickly, and when everyone around you is saying, "Get out," staying invested requires discipline. 20 years later, Sumit has owned his property for 20 years. The house may now be worth around $500,000, depending on the market. His mortgage is much smaller. His equity has become substantial. Rental income has helped cover many costs. But he also spent money maintaining the property. And he spent something else that doesn't appear on a spreadsheet: time. Lucas spent 20 years doing something far less exciting. He kept investing. His original $50,000 remained invested. He continued adding $200 every month. With strong long-term returns, the portfolio could become worth several $100,000. Lucas didn't need to predict the next giant. He didn't need to find the perfect stock. He didn't need to buy at the exact bottom. He simply needed to stay invested. So who won? The real winner. It would be easy to say one investment is better than the other, but that's not really true. Real estate has powerful advantages: leverage, rental income, potential appreciation, and the ability to build equity while someone else helps pay the mortgage. But it also comes with concentration risk and responsibility. Stocks offer different advantages: diversification, liquidity, low maintenance, easy automation, and the ability to own thousands of companies with a single investment. But stocks can experience huge temporary declines, and investors need emotional discipline to stay invested through them. So the better question isn't, does real estate beat stocks? Or do stocks beat real estate? The better question is, which investment fits the person using it? The best investment is one you can understand, afford, and hold for a very long time. The bigger lesson. Sumit accepted debt, concentration, maintenance, and responsibility in exchange for leverage and potential rental income. Lucas accepted market volatility in exchange for diversification, liquidity, and simplicity. Neither path is magic, neither guarantees wealth, and neither eliminates risk. The biggest mistake is believing investing is only about choosing the asset with the highest historical return. You also have to consider taxes, fees, debt, time, stress, liquidity, risk, and opportunity cost. Smart investors don't just ask, how much can this investment make? They also ask, what will this investment cost me? Not just financially, but in time, attention, stress, and freedom. 20 years from now, the winner may simply be the person who chose a reasonable strategy and stayed consistent long enough for compounding to take over. There is no universal answer. Wealth isn't built by choosing the perfect investment. It's built by making good decisions repeatedly and giving them enough time to work. The best investment is the one you can stick with for the next 20 years.